Don't listen to what others are saying. $100 is enough money to get you invested in some of the safest companies, and we're going to start right now. Alright, welcome back to my channel. My name is Jelfi Torres, and today's video we're going to be going over how you can invest $100 into the stock market in order to generate some passive income. And make sure you like the video and subscribe and hit the bell for notifications every Monday, Wednesday, and Friday when I'll be dropping more financial content. Alright, so the strategy that we're going to be focused on in this video is called dividend investing. What dividends are cash payouts that companies pay out to their shareholders every single month, every 4 months, every 3 months. It depends on the company. And the amount that companies will pay to their shareholders will differ depending on the value of the stock and what their dividend yield is for that month, because the dividend yield could change for most companies. Dividend yield is usually the percentage of how much they'll pay you based on the stock price. So let's say that a dividend yield is $10 and the stock price is $100. That means every single month or every single 3 months, depending on the time frame that they cash out their payouts, they'll pay you $10. If you would like to look into dividends more, you could go on dividend.com, and on dividend.com you'll be able to see the dividend yield of all the companies, and you get to see the top 20 recommended dividend stocks. And on the dividend.com website you'll be able to set filters based on preference you would like to have. So for example, if you would like to invest in a company that has a higher dividend yield, you'll be able to filter it based on preference. I would like to say that you have to be careful with companies that have a very high dividend yield. Those companies tend to put high dividend yields to try to attract people to buy their stock, and then later on in the week or later on in the month they'll decrease it. So high dividend yield is not sustainable, okay? Companies just can't pay out all their money out to shareholders and investors. But don't worry, in this video, we're gonna set a filter on the companies that we'll be focusing on, okay? And these companies are listed as Dividend Aristocrats. All right, so in order for a company to be qualified as a Dividend Aristocrat, they have to have increased their dividend yield for the last 25 years. Okay, so that means 25 years ago until now, they have been consistently increasing their dividend yield, increasing the amount of money that they're paying out to shareholders. Another requirement in order for a company to be a Dividend Aristocrat is for it to be listed on the S&P 500, which is essentially the top 500 companies in the United States. And lastly, the company has to be at least worth $3 billion. In other words, the market capitalization of the company is $3 billion at least. All right, at the time of this recording, there are 65 companies that qualify as Dividend Aristocrats. And guess what? A lot of these companies you already know. A lot of these companies are household names like Johnson & Johnson, AT&T, Lowe's, Coca-Cola. Back in 1987, there was a stock market crash, and investor Warren Buffett decided to buy $1 billion worth of shares of Coca-Cola, which now is worth more than 16 times as much with the dividend payouts that Coca-Cola has been giving. Essentially, what that means is with depreciation, the increase of value of the Coca-Cola stock plus its dividends, he was able to achieve a lot of profit from Coca-Cola. If you choose to invest in Dividend Aristocrats, you'll find that your portfolio will not range about so much. A lot of people have trouble managing their portfolios when they see price jumping up and down so much. In other words, volatility. There is not so much volatility when you're investing into Dividend Aristocrats, because, so let's say the share that you purchase from Coca-Cola decreased, okay? That's fine, because you know in the longer term it will appreciate in price, and even if it drops a little bit in price, that's completely fine, because at the end of the day, you're gonna get a dividend payout. You know, a lot of people get excited about these stocks that are just jumping like 10, 15, 20% in price, like Apple and Tesla. Not to say that they're bad investments. It's just not a lot of people have experience in the stock market, okay? The stock market could be very volatile at times, and it will be very difficult to control your emotions during times of high volatility. So it could be very scary when one day you're seeing, hey, I'm up 20%, and then the next day you're down 30%. You're like, what just happened? At the time of this recording, Apple's dividend yield is 0.61%, which is extremely low. That is for people who prefer to invest into growth stocks. We're focusing on Dividend Aristocrats stocks. And the advantage of investing into Dividend Aristocrats is with those cash payouts, you'll be able to buy more shares and you'll be able to gain what's called compound interest, which is a money multiplier. So you buy one share, right? And then you get a dividend payout to buy more shares and even more shares and even more shares. And your cash out is going to be huge. And your cash payout is going to get bigger and bigger. The more you invest back into the stock market, back into the Dividend Aristocrats. All right, let's get into how you can invest those $100. So first of all, you have to open a stock brokerage account with the broker M1 Finance. The advantage of opening an account with M1 Finance is that you'll be able to purchase fractional shares. So let's say you're interested in investing in a company called Pairs. You have $100, but a share of Pairs is $100. So how are you gonna buy it? That's the advantage of M1 Finance. You'll be able to buy $5 worth of Pairs or $10 worth. And usually with other stock brokerages, on top of those $100 that you would have paid for the share of Pairs, there's commission fees. There are no commission fees for M1 Finance. And with M1 Finance, you'll be able to get started on investing $100 into multiple companies, and you'll be able to lessen the risk exposure that you have to a certain sector of companies, certain companies that have seasonality. So for example, let's just say you're interested in Six Flags. When's the best time to buy the Six Flags stock? You guessed it right. In the winter when no one's going, that's when it's gonna drop in price. The way M1 Finance works is there's an entire pie that's divided by slices. And in those slices, there are percentages of different companies in which you would like to invest in. For companies that you are more confident in and that may pay a higher dividend yield, you may wanna give it a bigger slice of your pie. Okay, don't get hungry yet. Try to make sure when you are making your pie that you do not focus more than 10% of your pie into one company. That is exposing yourself too much risk to a certain sector. Like for example, in my Six Flags example, you should not invest too much money in Six Flags when it's about to be winter time. There's seasonality in stock. Usually most stocks perform well at the end of the year from September all the way to January. The reason why is because the holidays bring a lot more money because people are out there buying gifts, buying costumes, buying all of these decorations. Companies are making so much money during that. A smart way to enter into the market would be before you expect it to go up in price. So for example, when would Raymore and Flanagan do well? Now this one is a little bit more tricky because you would have to know when are people moving out, when are people moving, which tends to be between February and March. That's when there are the most amount of listings of real estate properties out there. And M1 Finance is not just about stocks. You can invest into trusts, real estate, bonds, ETFs. There are multiple instruments that you can invest into using M1 Finance. Awesome. Now that you've gotten to this point, I'm going to tell you what my offer is. My offer is to share with you a safe and conservative pie that I myself have invested money in. And this pie will help you get started with some diversification. I made sure that no company is worth more than 10% of any slice. The pie that I will share with you guys includes real estate trusts, bonds, ETFs, stocks, and by stocks, of course, is gonna be Dividend Aristocrat. And the Dividend Aristocrats that I have invested into are in various sectors. If you are interested in my pie, make sure that you use my affiliate link below and send me a DM on my Instagram at Jelfie Torres. Make sure you guys tune in to more content on this box over here, and I catch you guys in the next one.